Global equity markets suffered steep losses today, with the major indices across the North and the South America experiencing a broad-based sell-off amid the heightened investor anxiety. In the United States, the Dow Jones Industrial Average plummeted 2.203, that is 2,231 points or 5%, closing at 38,000, while the S&P 500 dropped by 9.6%. Also, the tech-heavy Nasdaq tumbled 5.82% to reach 15,000. These sharp declines reflect growing concern over the combination of factors, including the inflationary pressures, interest rate uncertainty, and potential earning disappointments. The Russell 2000, which tracked the smaller cap companies, has also hit hard, falling 4.37% to reach 1,800. Also, and the contrast with the CBOE, the volatility index, that is the VIX index, often referred to as the market, the fear gauge, has surged 50.93 points to reach 45.31 in its highest spike in the months, signaling a dramatic increase in the market volatility and risk aversion. Investors appear to be rapidly shifting out of equities and into the safer assets for the hedging their portfolios in anticipation of further turbulence. The sell-off extended beyond US borders. Canadian markets were deeply in the red, with the S&P TSX Composite Index falling 4.69% and the S&P TSX 60 down 4.44%, reflecting a widespread retreat from the risk across the sector, including the finance, energy, and other materials. Also, the Latin America market that has also faced significant pressure. The Brazil's Bovespa index sank nearly 2.96%, losing over 3,800 points, while the Chile's S&P IPSA and Mexico's S&P BMV IPC dropped 2.79% and 4.87% respectively. Today's market action also underscores rising unease among investors who are grappling with the tightening of the financial condition, geopolitical tensions, and a general loss of confidence in the near term and the economic instability. With the VIX speaking sharply, the key global indices shedding billions in the market value, sentiment has clearly shifted into the defensive mode. The coming days will be critical in determining whether this is a short-term correction or the start of a deeper, more prolonged downturn. Commodity market reflected a day of divergence, with the significant movements observed across the energy, metal, and agricultural sectors. Energy commodity faced strong headwinds, leading the day losses. Also, WTI crude oil declined by 2.15% to settle at $60, while the Brent crude oil dropped 2.21% to reach $64. These declines come amid the persistent concern about slowing the global economic activity, reduced fuel demand, and increasing inventories in the major consuming nations. Additionally, geopolitical tensions and uncertainty surrounding the OPEC Plus production strategy continues to weigh heavily on the investor sentiment in the energy space. Natural gas followed the suit, slipping 1.64% to reach $3.77. Though still with a relatively stable range, it remains vulnerable to the seasonal demand shift and the fluctuating storage data. In contrast, the metal segment painted a more optimistic picture. Gold advanced 1.10% to reach $3,000, maintaining its strong position near the up. Also, the 52 weeks range. Investors appear to be rotating into the safe haven asset amid mounting concern over the inflationary pressures, currency volatility, and broader macroeconomic stability. The silver posted the strongest gain of the day among the tracked commodities, jumping 4.57% to reach $30. The sharp rise may also reflect increased industrial demand as well as renewed interest from the investors seeking diversification from the equities and the fiat currencies. Agricultural commodities also showed resilience, with the soybean inching 1.07 to reach $9. The modest rise suggests continued global demand and potential supply disruptions, supply constraint, and the weather-related disruptions in the key growing regions. The commodities hovering close to the higher end of the 52-week range, indicating relative strength in the agricultural sector. Overall, today's performance illustrates a clearer contrast between the declining energy prices and the upward momentum seen in metal and agricultural. Also, market participants appear to be repositioning also their platforms and the portfolios in which anticipation of the economic shift are to be desired, possibly favoring hard asset and essential over cyclical commodities tied closely to growth and consumption. As volatility continues to define market dynamics, commodities will likely remain a focal point for both hedging strategies and speculative plays in the day ahead.